Welcome everyone to our special podcast edition today. It's not the Trust the Plan podcast, but it's a market update.
Market update. There you go.
Yeah. So first of all, we want to just remind everyone to take a couple deep breaths in through the nose, out through the mouth, and stay calm. Remember, this happens more often than we like to experience. But when it does, it always feels like the sky's falling. And we always are reminded that the market has always recovered. Okay, but we always think to ourselves, well, this time will be different. And each time there's a different narrative, but usually the market response, the market trend rhymes with history, right? So it could be COVID, it could be a Russia invasion of Ukraine. It could be the great financial crisis. And the trends of the markets, they always rhyme, but there's always a different reason. Right, Jim?
Yeah, I think what markets don't like is uncertainty and when they don't know what to expect. And that's what you can draw that parallel with all of these significant events over, decades and decades, right? But once the market figures out what's going on, understands how to adjust and adapt, that's when we start to see recovery. So I think that's what we're seeing right now is just a lot of uncertainty.
Yeah, and so this time around, it's the tariffs and it's the new worry about recession. And so, entering last week, the market was down. It hit minus 10%, but it had recovered a little bit. But then after the president's tariff announcements on Wednesday night, it really sent shockwaves through the system. And you have to remember that everyone knew that these tariffs were coming, but there was a certain expectation of where they would be. In fact, when he first said we're having the reciprocal tariffs, the futures markets went up a little bit because it was just maybe a relief. Oh, that's all it's going to be, just the reciprocals. But then when he pulled out that chart and showed that it was going to be actually much more than reciprocals, that's when the market started selling off. And once selling starts, sometimes selling creates more selling.
Absolutely.
And so overnight on Sunday night, we actually touched a minus 20% level on the S&P 500, which signals a bear market, which is a recession warning. The NASDAQ, the Russell 2000 small caps, they've already entered a bear market. And so we have to think to ourselves, why would tariffs cause a 20% sell-off and cause trillions of dollars of damage in the markets? And so maybe you think, well, maybe we were a little richly valued coming into this year, or maybe there's something more to it. Okay, and so we'll talk more about that later. But the tariffs were certainly the catalyst here. And so if this is a bear market, technically that was the futures action, so it wasn't the regular market action. And so if we are at a minus 20% level, this would be the third bear market in 5 years, 2020, 22, and now. And that has never happened before. So that's kind of unique. Glad that we're living in this age, right?
Right.
The good news is that the international has held up much better, and our bonds are doing great.
Yeah, that was the challenge in 2022, where stocks and bonds were down at the same time. That was kind of unprecedented. But what we've seen recently has been a case for remaining diversified.
Certainly. So, Jim, let's look at this chart for a minute. This one is very busy, but what we can see here is that we're 44 days into this since February 19th. And as of Friday, we had a 17.5% decline. And so, that's pretty close to a bear market, which is minus 20. And you can see there's many times that we've had 5% corrections since 2009, a couple dozen of them. And many of them occurred in 18 and 19 when we were talking about tariffs and trade wars, but they were certainly not as bad as this one. In 2018, when we hit minus 20%, that was, I would say, more so about the Fed raising rates too quickly. Whereas in 22, we had a minus 27% bear market, which was certainly the Fed raising rates and Russia invading Ukraine. And now this time we're at the minus 17.5. But it's happened pretty quick, right? To be 44 days at minus 17.5. You can see in 2018, took 96 days, for example. And so this happens quite often, right? And there's always a different reason.
Yeah, it's not the first time we've seen the word tariffs and trade wars. And Preston and I did a podcast a couple weeks ago, right, where we talked about all the different monumental events happening in the world, and the overlying theme was, look, even through those bad times, good times come in the end.
Yeah. Okay, so this is the stock market, right? And we talked for a second about bonds and everything. But if we're just using a balanced index portfolio, which includes, right, everything we mentioned, stocks, bonds, international, and we have a global diversified blend, right? That type of a portfolio is down 4.6% in 2025 as of Friday, whereas stocks are down over 13.5%. So this is really helping to show diversification helps, especially in times like this. And so, if we're down 4 point something percent, it feels nasty, okay? But it is certainly not the end of the world, right? As I was saying, bonds were up 3% so far this year, and you were mentioning that's so different than 2022. And so here we are, we're down in this hole. It could continue, right? There's no magic formula that says minus 20 and that's it, right? We just don't know what's happening next. We know that there's new news coming out of Europe regarding the tariffs today, and that's providing a bid for the markets. We'll see what happens as time goes on. But Jim, this is our market emotions cycle. Where are we right now?
Yeah, I think this chart is great because it shows you where your emotions are at different parts of the cycle. When things are great, you have thrill, euphoria, everything's great. It starts to go down. And this is probably where we're getting, right, is in this region down here where desperation, panic start to set in, capitulation, which is just, I don't even care, sell it all. I got to get out, right? And the market reacts irrationally. Despondency is another one where it's, I can't even look anymore. Don't even log in. And I feel like that's a lot of what we're hearing from clients and from people and from the media and what you name it, right? There's a lot of uncertainty and panic that, leads us to believe that we're down near the bottom of the emotional cycle.
Maybe markets just aren't for me. I had someone text me last night, something to that effect. Maybe I should just invest in real estate instead. But real estate can go down too, just like 2008. And so that's why it's good to be diversified. And so one thing I want to highlight, when we get down to these levels, what typically happens next, right? We want to learn from history. Our emotions tell us one thing, but we have to cognitively realize the history of markets here. And so this is a great chart, and it talks about the VIX levels. And VIX the VIX index measures fear. So when fear gets this high, and this fear index is at 45 on Friday, what typically happens next when it's in this range? And look at all these examples going back to 2008. And actually, it has very rarely been this high, right? This VIX index, very rarely. But what typically happens next? Okay. And so, we have 1,000 batting average here with the average return of the market plus 28% looking forward 1 year. I'm not saying that that's going to happen here, but this is what has happened in the past. And that is pretty interesting to me. Here's another one. Remember, this was a 2-day decline. We were sitting okay on Wednesday, and then we had basically minus 5% on Thursday, minus 5% on Friday. It was a minus 10% 2-day decline. When have we seen these big 2-day declines before? 1987, COVID, and 2008. That's it. So this is on the extreme level of volatility and negative markets for a 2-day period. But again, look what happened 1 year out, or 3 years, 5 years out. 1,000 batting average here when we have terrible days like this. All right. And 1 year later, the worst one was just 9% in 2008 because you basically bought too early in that case if you were a buyer. But almost all of them are up 100% 5 years later, which is quite remarkable.
I think that illustrates the point that oftentimes at the point of maximum fear and discomfort with what's going on is the maximum opportunity.
Yeah.
You know.
Yeah, that was on the chart. At the very bottom
Yep.
was maximum opportunity, and at the very top, it was maximum potential risk.
Yeah.
Okay, so given that we're already down at one point 20%, and we know that when it gets to these types of levels, if we're able to bear the pain short term, the long term benefits are very worthwhile. What are some of the things we can do if we are optimistic about if we want to be opportunistic?
Yeah, I think the first thing is trust the plan, right? Know that the plan that you have is still intact, it's still on track, it still works. Even though we've seen a pullback, it's very unlikely that it's affected your long-term plan. So I think that's the first thing you can do is not shoot yourself in the foot by getting out at the worst time.
Yeah, we've put the plan together. We've stress tested it. Let's trust it.
Yeah.
Okay, now if you're opportunistic, like I am, I'm 45, still working for many years. I want to be opportunistic, so I could consider investing at these levels, adding more money. I could also think about a Roth conversion, because if I do a conversion when the market is down, it allows me to convert more shares, and therefore, when the rebound comes, I get a better bang for my buck. Now, Jim, if we were thinking about adding more money, let's say we just got a big bonus for $100,000, would we want to put it all in on one day?
Yeah, I mean, I think what we've seen recently shows that you can make a case the dollar cost average, meaning move it in slowly over time. And we've had a couple cases here recently where clients have come into a lot of money and we said, let's take our time, put it in slowly. And this is exactly why we don't know where the markets are going short term. You never know from week to week if we're going to be up or down, but we know long term chances are good that we'll be ahead. So it just gives us an opportunity to hopefully buy at better prices.
Yeah, I mean, you could make a case to buy at minus 10%, minus 15%, minus 20%. And so you want to be able to have some dry powder to take those shots rather than doing it all at once.
Yep.
Right? Okay.
You have timing risk if you put it in all at once.
Yeah, that's right. And then if it keeps going down, you're out of money and you're sad.
Right.
Yeah. Okay, so what about if we're already retired and we're thinking, okay, well, this is great, but how do I take advantage of this? Well, like Jim said, you have to trust the plan, and you simply have to not shoot yourself in the foot when you're down in the hole.
Timing the market is so unbelievably difficult. Whether you're trying to get out at the bottom, get out at the top, get in at the bottom, it's just so hard to do. And we see it all the time where, a comment from the president or something that comes out in the news, anything like that can move the market dramatically. So thinking that we know what's happening next is just a big pitfall. Thinking I know this is going to go on for a while, so we got to get out and then wait for it to be at the bottom and then get back in. That is just so hard to do. So I think, kind of like we've said a couple times, just not shooting yourself in the foot is the right way to go.
Yeah, and being right twice is almost impossible. You have to get out at the top and then get in at the bottom. And even if you were lucky enough to get out at the top, most likely what will happen, because we've seen this investor psychology over 2.5 decades, is that when it's down and there's the maximum financial opportunity, like that chart was showing, let's go back to it. This is the point of maximum financial opportunity. That's when things looked so bad that you think, well, I'd have to be crazy to put money to work here.
Yeah.
And then you don't. Okay? And then you let it rebound all the way up and wait for the blue skies, back to the point of maximum financial risk, and then put it to work. That's just the way people do it. And so, it's better to just have the right risk coming into the event in advance, because you never know when it's going to happen. And then I would also say, if you feel like if you're saying to yourself right now, 3 bear markets in 5 years, maybe this just isn't for me. What we need to do is talk about risk and make sure that when we've had a rebound, then we can reduce risk once we have better prices. We can't, I think it's really smart to have some patience here and wait for a rebound and then do some rebalancing. That's another point. Another thing that we're doing today is doing some rebalancing. Some people just rebalance every month or every quarter, but the most important time to rebalance are at times like this, when you have the opportunity to sell something that's high and buy something that's low. That's how you add value. Okay, I think we covered it all. If you want to talk, please call us, email us, use the texting line. We will call you right back. And we appreciate the trust and confidence that you have in our work. We appreciate your partnership. And once again, let's take some deep breaths in through the nose, out through the mouth. Thank you.